Welcome to the Clinical Strategic Audit for the week of February 16, 2026. As the market enters a shortened holiday week, we are witnessing the definitive transition from AI awe to AI poverty. Today's primary winner is NVIDIA. While its customers cannibalize their balance sheets, NVIDIA remains the sole tax collector of the AI era, navigating the monetization gap by force multiplying infrastructure with the Vera Rubin platform. Conversely, the losers hitting the reality wall are Amazon and Meta. These hyperscalers are deploying roughly 2.5 years of future earnings in a single fiscal year, leading to a projected 90% collapse in free cash flow for Meta and potential negative cash flow for Amazon. The market is no longer rewarding the spend. It is scrutinizing the drain. The data is sobering. The combined capital expenditure for the 5 largest AI hyperscalers, Amazon, Alphabet, Microsoft, Meta, and Oracle, is now projected to exceed $700 billion in 2026. Amazon leads this charge with a staggering $200 billion commitment, a 56% year-over-year surge. Alphabet follows closely at $185 billion, while Microsoft is pacing at a $151 billion run rate. These figures represent nearly 25% of all U.S. corporate capital investment. The scale of this industrial build-out has no historical precedent, creating a massive bottleneck in the physical layer of the economy. We are tracking a fundamental divergence in balance sheet health. Google recently raised $20 billion via a multi-tranche bond sale, including a rare 100-year sterling bond. This move underscores the capital-intensive nature of the AI push. Alphabet's long-term debt has increased fourfold to $46.5 billion. In contrast, Apple remains the outlier. With a disciplined $13 billion capex budget and a $130 billion cash buffer, Apple is positioning itself to buy the AI dip. By treating large language models as a commodity and adopting Google's Gemini for its Siri overhaul, Apple is avoiding the infrastructure trap that is currently compressing margins for its peers. The AI scare trade has metastasized. This contagion is liquidating value in sectors once thought to be AI-resistant. In logistics, C.H. Robinson plunged 24% intraday following the launch of the semi-cab platform by Algorithm Holdings, Rhyme. This agentic tool manages over 2,000 freight loads annually, quadruple the human baseline, evaporating the human moat in brokerage. The fear has jumped into financials. Wealth managers like LPL Financial and Charles Schwab are down 8% after the startup Altruist launched an AI tax planning solution. Even real estate giants like CBRE are under fire as Anthropic's Claude Cowork automates labor-heavy lease auditing. The market is signaling that if your business model relies on billable human hours, you are now in the crosshairs of the SaaSpocalypse. To de-risk their roadmaps, the Mag 7 are moving into the physical layer. Meta has emerged as a nuclear hegemon, securing up to 6.6 gigawatts of nuclear energy through deals with Vistra, TerraPower, and Oklo. Microsoft is similarly securing behind-the-meter power by restarting the 3 Mile Island reactor. These are not environmental pledges, they are strategic moats. As AI data centers prepare to consume energy equivalent to the national output of Japan, the companies that own their power supply will survive the grid moratoriums and frequency oscillations that are beginning to plague the public utility networks. Institutional positioning has shifted from AI awe to AI quality. JPMorgan's Doug Anmuth stresses that 2026 is the critical turning point where hyperscalers must deliver tangible financial returns on these multi-billion-dollar investments. Goldman Sachs is highlighting massive dispersion within the Magnificent Seven, questioning whether AI enhances or cannibalizes core business models. Finally, Deutsche Bank notes that the scare trade seeds were planted in 2022, but the recent launch of agentic plugins has triggered a sell first, think later regime for any company relying on legacy service models. Technically, the cohort is entering the week in a deeply oversold state. The Roundhill Magnificent 7 ETF is carrying a 14-day relative strength index, or RSI, of 26. This is a clinical strong sell signal reflecting extreme momentum to the downside. NVIDIA holds an RSI of 35.1, trading below its 200-day moving average of $185. While technically weak, the stock RSI at 11.6 indicates the stock is reaching a local bottom. All eyes are on the February 25th earnings report. If NVIDIA can prove that the shift to inference is driving productivity in the physical economy, this oversold condition may provide a historic entry point. In conclusion, the Mag 7 are no longer just software companies. They are the central planners of the global energy and infrastructure grid. Prioritize companies with infrastructure moats like Microsoft and Meta over software-only firms facing disintermediation. The human moat is evaporating in logistics and finance, and free cash flow sustainability is now the only metric that matters. As we wait for the NVIDIA report card on the 25th, stay nimble, monitor the RSI for a relief bounce, and remember, in the era of industrial AI, the winner is the one who owns the power.